So in 2025, small to mid-cap private equity continued its outperformance to large cap private equity, largely a function of leverage. So large cap private equity tends to have higher levels of leverage, and with the interest rate environments, that's negatively affected that. Again, in small to mid-cap, we saw a continued supportive exit environment. So within the Schroder Specialist Private Equity Fund, we had 3 full exits and 1 partial exits. All the full exits were returning between 2.2 and 4.4 times money. So we're continuing to see that small to mid-cap private equity where you find attractive companies, grow them, and then we're able to exit them, and an exit in paths that aren't reliant on the IPO market, which is particularly important at this juncture. Additionally, within the portfolio, we saw some really strong momentum with one of our key companies, Galaxy Universal. They won the contract to be the global partner for Reebok, which is putting them in the number 4 position of shoe manufacturers globally. Yeah, so it's a really interesting dynamic at the moment. As with the Schroder Specialist Private Equity Fund, there's been increasing interest in evergreen funds, which allow people to get immediate access to private equity rather than a traditional closed-end structure where you may have to wait years to get your capital call. This structure has been really appealing. Additionally, secondaries funds, the number of secondaries funds conducting capital raising has quadrupled in the past 6 years. So we're seeing capital flow into these parts of the market, which for us is a leading indicator just to remain really selective in terms of the deals that you do. So within secondaries, it's quite interesting. There's 2 main types of secondaries in the market. LP secondaries, which are buying secondary stakes off other participants in the market. This part of the market we're still quite conservative on. We think it's quite efficiently priced and there's not a huge room of value within these deals. So we're being really selective and basically not participating in those if they're put out to a big auction. The second part of the secondary market is GP-led secondaries or continuation vehicles. That's where we're seeing really good dynamics. We're seeing lots of opportunities in this part of the market. And it's really where you can get in, underwrite the company, find key companies that, again, you think are going to perform throughout the market cycle, underwrite those and get access to them. The other thing we really like about continuation vehicles is with this structure, it's the same manager managing the asset, often the same board of directors, the same management team. It's just a new legal structure. So it removes one of the risk levers of private equity in terms of it is just a continuation of that company on its same journey. Yeah, so I think the larger the universe of companies to choose from, obviously the more selective you can be. And as we're seeing in listed markets, it's becoming a really concentrated basket of companies in listed markets, which removes that selectivity. In small to mid-cap private equity, you're looking at about 450,000 companies to choose from. Within the way we invest as well, there's a universe of about 5,000 managers to choose from, and we've picked 300 to 400 to partner with. And those managers are on the ground canvassing those 450,000 companies and selecting the ones that they think are really going to continue to drive value. Also in the small to mid-cap private equity market, you just benefit from the law of large numbers. It's much easier to double or triple the size of a small company than it is to do that with a much larger company. And your risk drivers tend to be more independent of the economic cycle. So we're really looking for a portfolio of companies where the underlying risk factors, the drivers of success are quite independent from things like GDP or interest rates. It's more, can this small company implement a more efficient sales process? Can this small company conduct some mergers and acquisitions to help generate value? So that's what we want. We want that portfolio of companies where really each individual risk driver is quite idiosyncratic. You can kind of stay away from some of the noise of listed markets. So the great thing about having a global view is you can look a little bit away from the US, where we do just see elevated prices. Of course, the US is the largest market and can't be avoided and still a key component of our fund. But when you look outside the US, for example, Europe, the companies there just simply trade at cheaper prices. When you look across the global private equity universe as well, in 2024, actually Europe outperformed the US, as did our fund. So again, you're providing a bit of diversification there. And year to date for 2025, we're starting to see some similar trajectories. Similarly, in markets like Asia, where in India, for example, we see positive population growth. We quite like getting exposure to that region. Western world, Europe, North America, you're looking at aging populations. Asia, you can find those components of growth through things like demographics. So we really think having a global mandate, but one of the unique parts of our platform is we have a single investment committee. So they're really providing that pricing discipline, surveying every opportunity across the globe and deciding which ones based on relative value will go into the fund. So that global reach, but then single point of decision making really provides for a well-constructed global portfolio. I'd say the difference for small to mid-cap private equity really boils down to three main components. The first one is that small to mid-cap private equity simply trades at lower prices. When you think about the process for underwriting and buying a private company, it takes the same amount of time and effort if it's a small company or a large. So many investors are so large that they're really forced to only invest into the large cap private equity. So you get a pricing discount in small to mid-cap. If then you get that right, you find that small company, you grow it, transform it, you can actually sell up market to a larger investor who'll pay you a higher multiple of those earnings. So if you get that trade right, you not only benefit from the earnings growth, but you benefit from someone paying you a higher multiple of those earnings. So that's a really great factor about small to mid-cap. Secondly, as I touched upon earlier, these companies tend to have lower leverage. So in an environment where people are worried about rates staying higher for longer, that stability of knowing you don't have a big debt service burden on that company can help propel growth, help it remain more stable in times of volatility. And finally, also, as I touched upon, you've got simply more exit routes for small to mid-cap private equity. So there's an expression, elephants have to marry elephants. If you're in the large cap private equity part of the market, you've only got fewer paths to exit. It could be IPO or exit to another behemoth fund. But in small to mid-cap PE, and particularly this year, we've seen two of our main exits to strategics, so corporates in that same sector. So you've just got those more multiple paths of exits, which allow us to do what we want to do, which is really find those good companies, grow them and exit them in a way that's not too cyclical in nature. So for 2026, Schroders Capital private equity team is really going to stick to its knitting. We're still very bullish in small to mid-cap private equity. It's a part of the market where, as I say, it's a very formulaic way of investing, really down to fundamentals of finding those good companies at attractive prices, growing them and exiting them. As I mentioned as well, we're still quite bullish on GP-led secondaries, where you're taking those star performers of managers, companies they might have owned for 2, 3, 4, 5 years, already doubled in value, but where they can clearly see another path to double or triple in value. About 2/3 of activity in continuation vehicles as well is in the small to mid-cap part of the market. So again, we've got that selectivity in that part of the market. And then again, our global reach, ability to look across secondaries, co-investments and primaries across Europe, North America and Asia allows us to be really selective and find those companies that we think are going to thrive somewhat regardless of the economic environment.